Good morning. Welcome to FX in 4. Today is Monday, August 8th, 2011. This morning, we're dealing with the aftermath of S&P slamming the U.S. credit rating. Now, on Friday after the close, S&P came out, and this is for anybody who's been living in a box here for over the weekend and doesn't know what's going on. But S&P lowered the credit rating of the U.S. from its AAA standard down to AA, citing the political climate that we have in Washington and the inability to for people to get stuff done. Now, they put out a warning prior to the debt ceiling negotiations that they wanted to see a certain level of debt reduction taking place, and obviously that wasn't the deal that was made. It fell far short of that, so S&P followed through on their threat, and they went ahead and they downgraded U.S. credit. Well, a couple of things going on here. One, okay, you have to think about this in terms of the U.S. is never going to default on its obligations, all right? That's the first thing. So by that, in and of itself, people say that's the gold standard, all right? We have the ability to print our own money. Bernanke has shown the willingness to do so, all right? So all they have to do is keep printing money that service our debt, all right? Now, the question is that a good thing to do, all right? Now, that obviously is something that's an entirely separate issue. But I think what this S&P downgrade really does, it really, speaks to the climate in Washington about politicians and their inability to work together, all right? It also has to do with some of the problems that are facing us and some of the hard choices that we have to make here in the U.S. And, most people don't want to go ahead and do that. I mean, let's face it, 100% of the people like a free lunch. That's just how it is. Once you have something that's a, quote, entitlement, that's exactly what it is. People feel entitled. And, some of these things have to change. So, we've seen markets are selling off here in a very big way. Asia was down huge overnight. Stocks down 2.5% to 3%. Same thing in Europe. We've got S&P set to open. We can take a look here and see how this is trading this morning. I'll just show you S&P here on the chart. Let's look. S&P down to 1170. You can see here, massive sell-off. This is it right now, with futures opening for trading yesterday. One of the plus sides to this whole debacle, if you want to call it a plus, is that we see the same move in oil. Oil prices going lower. So that's pretty good, right? Now, lower oil prices mean less inflation for people, which is good. All right, cost of goods perhaps comes down. But now this is going to start the rhetoric about we're in a deflationary cycle. And what's Bernanke going to do at the Fed? Is he going to go in and is he going to start printing money like a madman again because we're in this deflationary cycle? And I think there's probably a pretty good probability that he will. So what we've seen here is that as a result of that thought, all right, what's the hedge against inflation? All right, safe haven, gold. And look at gold, bam, right up to it's R3, or excuse me, yeah, it's R3 resistance. All right, it's 1714 high. That's a pretty nice number. Now, I was looking at gold just on Tuesday at 1630 and saying, man, it's tough to buy it here, but it just looks so darn good. And sure enough, there it is. So, it's possible if things continue to get worse, we could see gold climb a little bit higher. And especially if Bernanke turns the printing press back on, don't be surprised. You hear these crazy gold bugs, no offense to crazy gold bugs, who, are calling for $5,000 gold. And you know what? It's when you see situations like this, it's not outside of the realm of possibility. All right? I don't want to start to sound like one of these guys come drinking the Kool-Aid here, but the dollar's in big trouble, and that's going to be an issue going forward. So let's just take a look at some of the dollar pairs here. All right, you can see overnight we had, let's just look at the euro because that's the most. No, we're on the 15-minute chart. All right, right here when markets open, euro spiked higher. All right, and then it looks like we put in a little double top here on a short-term chart, 15-minute, and we've got the euro selling off now. Well, why? Well, we've got actually people running to the flight to safety trade. So there's problems with the U.S., go get back into the dollar. Seems counterintuitive to some, but the dollar is still really the only safe haven asset game in town. U.S. Treasuries, all right, as we mentioned, will never be defaulted upon. Okay, even if the political climate gets so ugly that things here don't look good as S&P is claiming, you know what? We're always going to pay off our treasury debt. It might be with worthless dollars because of hyperinflation and excessive money printing, but you will get back that nominal value. So, bear that in mind. So, the reaction around the globe has been, different from China saying, U.S. has to get their house in order, to other people saying this doesn't mean anything in the grand scheme of things. We're still going to buy treasury debt, which is true. It just doesn't mean anything. I mean, who the heck is S&P? S&P are the people who dropped the ball during the entire credit crisis, or the banking crisis, rather, when they rated stuff that was AAA, this garbage, toxic mortgage assets. All right, and don't be surprised if the Justice Department pays them a visit sometime soon. That would be right out of the Chicago-style school of political playbook. So if I were S&P, I'd be really concerned about the skeletons in my closet. But that's probably for another time when they're a little bit less out of the focus and the limelight. All right, but meanwhile now the U.S.'s credit rating is lower than a variety of countries, particularly Italy and France that we're speaking about here, that have this huge problem in Europe. Well, the ECB's come out and said they're going to aggressively start buying Spain and Italy's bonds, quantitative easing, all right, and they're starting to do so to help drive yields lower there. Well, they didn't really do it for the periphery countries, Ireland, Greece, Portugal, but they're going to go ahead and start doing it now. So they're digging their heels in. Looks like they're all in, and it's probably going to help, with the situation going on over in the ECB. But in the meantime, there's no real news today, which really made this an ideal time for S&P to pull this off, which I'll give them credit. All right, they warned the administration on Friday, and they talked back and forth about the big $2 trillion error, and it's become pretty obvious that S&P really isn't concerned about the mathematics as much as they are about the politics behind it. And you have to understand is that as a credit rating agency, while I bag on these guys because by and large they're pretty useless, all right, there's a lot of different risks that you have to factor. Okay, it's not just a default risk, which we know is zero. Okay, but it's also political risk. There's currency risk. There's all these other risk factors that go into rating something. And you know what? Quite frankly, I think what they did was a good thing, because it really brings focus back to the fact that we've got a dysfunctional system here in the U.S. Politicians can't get their act together, and let the blame games begin. I've already seen these people out trying to blame this on the Tea Party. This is a Tea Party downgrade. Well, you know what? Maybe it's also a presidential downgrade. All right, it's also a congressional downgrade. All right, everybody is guilty of this. Okay, and nobody escapes blame. All right, and hopefully this is going to pick up the discussion and cause people to realize, hey, wait a second, you know what? Maybe it's time for some changes here. So that's kind of what we're looking at. So here's euro. You can see euro now is selling off with the dollar strengthening as the flight to safety trade goes on. But you can see here dollar. I'm just going to pull up dollar yen. All right, dollar weakening against yen, and you can see that was the initial move that happened right out of the gate, which that makes sense as well. All right, you can see euro versus Switzerland. All right, actually it's starting to bounce a little bit, but I'm not sure where this bounce came from. Hello, look at that. But euro versus Swissy coming down, back down towards these all-time lows here at the 107 area. What else do we have? We have Aussie selling off, typical risk aversion trade. Okay, Aussie came down, bounced right off its S2 here on the pivot points, right at 103 even. That's a pretty fat round number. All right, Australia, there's a AAA rated country that actually pays some pretty good interest. So it's going to be interesting to see if some of these risk themes start to break down a little bit. But meanwhile, you've got people still moving back into treasuries. That's not an issue. Okay, yields are actually lower as more money goes into treasuries. So it's not having the same effect that some people are having. So right now we've got stock futures down around 250 thereabouts, and we could see some initial selling as people kind of get out of these things, and maybe some stops get triggered. But by and large, I'm guessing that now that the news is out and the cat's out of the bag, that this is probably going to be a pretty decent buying opportunity along here somewhere. So anyway, it looks like regardless of what actually takes place today, that we are going to be seeing some increased volatility as the market sorts through it all. So that's what I've got for today, folks. Good trading to all.